Welcome to both of you. Kutgun, let me start with you. What is the expectation, whisper-wise, going into this afternoon? Expectations high or low, you think?
Sure, I think they're pretty high. I mean, for the quarter, as always, there'll be a lot of attention on the performance with streaming, particularly around Disney Plus net adds, and how much of a churn issue there may be following the recent price increases, as well as the progress with getting to profitability in 2024. And of course, an update on trends across the theme parks and whether or not the strong momentum we've seen over the last year or so can be sustainable, even with some pockets of softening across the consumer. That said, we expect results will take a backseat to management's updated strategic and operational visions following Bob Iger's return and the ongoing proxy battle with Trian. So a big focus on, what is the true earnings power of Disney? How will Disney's approach to Disney Plus content spend evolve in the coming years? And to me, most importantly, what does Bob Iger think about how aggressively Disney has flexed its pricing power over the last year? So a lot to listen to, though, particularly with the activist involvement. It's hard to imagine that Disney will not lay out a foundation for a stronger path ahead.
Yeah, Julia, as far as I'm concerned, one of the big fun questions for Disney, maybe not so fun for them to constantly grapple with, but are they or aren't they a sports company? In other words, what's the future of ESPN? What are some of the strategic alternatives? And how much is Bob Iger likely to worry about this as being one of the main ways that he sets out his vision for Disney at this point?
Well, I think that this earnings call is going to be much less about the actual results from this past quarter and much more about the restructuring that Iger indicated was in the works. Right after he took the helm as CEO, again, he appointed this committee, some senior leadership in addition to himself, including CFO Christine McCarthy, Dana Walden, who runs the TV division, Alan Bergman, who runs the film studio, and Jimmy Pitaro, who's in charge of ESPN, and said, these are the people who are going to help me figure out how to restructure the company. And I think in terms of succession, the big question is, does he take any of these four people and put them in a position that's like a COO position that would set them up to potentially succeed him? And I think there's a big focus on succession, not just from Nelson Peltz, but also from investors as well. And so I think that's going to be a key area of focus. And I think when it comes to the roadmap for Disney's future, ESPN as well as Hulu and what he does with those assets are in the spotlight. So I would look there as well. And then this all, of course, comes against a backdrop where analysts actually expect that Disney Plus will have fewer subscribers now than it did at the end of last quarter. And that's because, in part, because of the price hikes that they implemented. Right.
That's true. It's not cheap. Kutgun, do you see Disney going to 130 because of or in spite of Nelson Peltz's involvement?
I think in spite of, Nelson Peltz's involvement is certainly interesting. I think lights a fire under the management team, perhaps. But it's important to keep in mind that management already has set out a fairly, attractive roadmap to improving things like putting more power into the content makers in the company and decision-making in their hands, focusing a little bit more on cost cutting, and even thinking about the theme parks, trying to figure out how to improve the guest experience over there. So, I think Nelson Peltz, again, certainly maybe an accelerator to certain initiatives, but, the company already has its handful, and I think they're doing everything they can, and I certainly expect to hear a lot more today after the close.
What do you want them, Kutgun, to do with ESPN?
I think I see no reason they need to separate it. I think we're in the very, very early days of exploring the full potential of what the sports streaming marketplace could look like. But as making a deal, I mean, let's put it this way, not about the merits of ESPN itself, but if they can offer that in exchange, for instance, for owning Hulu outright, the art of the deal here, should they do something with this leverage that they have? I think the leverage profile is fairly manageable, especially as we see losses at direct-to-consumer start to abate and hopefully starting next year get to profitability, break even, and then profitability. And I certainly don't see an issue with the balance sheet where they need to have a deal and need to monetize ESPN to acquire the remaining balance of Hulu. So I don't think they need to step back from streaming whatsoever. I think it's just more a matter of being smarter with streaming, making sure they're monetizing the subscriber, making sure they're improving the cost structure, and perhaps being a little bit more flexible with how they're allocating content and whether or not it has to all go toward the flagship Disney Plus service, or can they be a little bit more creative and monetize it in other pockets?
I meant leverage, by the way, in the sort of old school sense, but I appreciate the balance sheet remark as well, because that's even more important.